68 days ago, the world changed. The first missile flew at 3:42 in the morning, local time. By sunrise, oil futures had jumped $7 a barrel. By the close that Friday, the spot price was at 104. Today, it sits at 125, a 4-year high. The most expensive crude has been since the Russian invasion of Ukraine. Drive into any California gas station this morning, the pump reads $6.04 per gallon, up 30% in 68 days. In Texas, $4.80. In New York, $5.50. The pain is real and it is everywhere. Then look at Wall Street. The S&P 500 closed yesterday at 7,209.01. A record high. The same exact day, California gas crossed $6. The same week, the strategic Petroleum Reserve hit a 40-year low. The same morning, Trump rejected Iran's ceasefire offer for the third time. And the morning notes from every major desk in Manhattan. They all say the same 5 words. Iran tail risk is contained. Iran risk is underpriced. The market needs to catch up. They are watching the wrong gauge. And the gauge they should be watching is screaming. The protagonist is not Iran. It is not Trump. It is the same gauge Wall Street has watched for 40 years. The CBOE Volatility Index, the VIX, the fear gauge. Right now, it sits at 15. Calm, the same level it sat at the day before Russia invaded Ukraine, the same level it sat at the day before Lehman fell. When the gauge says calm, the strategists say underpriced. They have it backwards. Here is what every Wall Street note tells the desk this week. Quote, Iran tail risk is contained. End quote. The market agrees. Oil futures 1 year out, $88, 68 days into a regional war that has tripled California gas prices. The market is pricing the war ending. Soon. Cleanly. With supply unaffected, there is one number nobody on the desk is showing the client. The number that says they are wrong. We get to it in 2 minutes. Pull the Energy Information Administration Weekly Petroleum Status Report. Strategic Petroleum Reserve. 350 million barrels. The lowest level since 1983. That is the data point hiding in plain sight. The reserve was designed for exactly this scenario. A war in the Middle East. A supply shock. A presidential authorization to release barrels into the market to keep gasoline below $5. The reserve is now too small to do that for more than 90 days. Open the Commitments of Traders report. Hedge funds reduced their oil long positions by 12% last week, the largest weekly cut in 18 months. Read the implication carefully. The smart money is selling oil into a 30% rally during a war. Either they know something the strategist note does not, or they are about to be very wrong. Open the Fed 10-year break-even inflation rate. 2.4%. Inflation expectations have not moved a single basis point in 60 days. Bond traders are pricing the war ending without a sustained supply hit. 3 sources, 3 issuers. The same picture. Wall Street is not pricing this war. The market is pricing it ending. The two are different. One of them is wrong. The Strategic Petroleum Reserve does not lie. It does not have an opinion. It has 600 million fewer barrels than it did the last time the United States went to war in this region. 2003, Iraq. The reserve was at 700 million. We have gone to war in the Middle East with our supply cushion at the smallest level in 4 decades. And the strategist note still says tail risk is contained. Here is the twist. The contrarian data flip, the consensus is missing. Wall Street is not pricing the war because Wall Street has never priced this war. 68 days ago, when crude was at 96, the strategists said it would be contained. The Iran response would be limited. Oil would settle back to 80 by month end. 45 days ago, with crude at 108, they said it would be over. Diplomatic channels were active. The supply disruption was temporary. 21 days ago, with crude at 115, they said the oil market was overreacting to a localized conflict. Today, at 125, they say Iran risk is underpriced. They have been saying the same sentence for 6 different price levels. Read that again. 6 different price levels, same sentence. The market is pricing the version of the war that was supposed to happen, not the version that is happening. And the gauge that should tell them the difference is broken. The VIX measures equity volatility. Equities are at all-time highs. The S&P closed at 72.09 yesterday. The VIX is calm at 15, so the strategists look at the VIX and they say the system is calm. But the VIX cannot see oil. The VIX cannot see gas at $6. The VIX cannot see the strategic Petroleum Reserve at the lowest level in 40 years. The VIX cannot see the hedge funds quietly cutting exposure. The VIX measures the thing that is not breaking, and then it is used to argue that nothing is breaking. They are watching the wrong gauge, and the right gauge is screaming. What breaks next? 3 triggers, all measurable, all visible at primary sources. None of them on the strategist note this week. Trigger 1. If oil holds at 125 for another 60 days, headline inflation crosses 3.2%. That is the Bureau of Labor Statistics threshold above which the Federal Reserve dove pivot, the equity market is pricing dies. The S&P at 72.09 is not pricing a hold above 3%. It is pricing a cut by July. One number kills that pricing. Trigger 2. If the Strategic Petroleum Reserve falls another 50 million barrels, the Department of Energy is mandated by statute to halt the drawdown. The cushion stops cushioning. The administration loses the only tool it has to keep gasoline below $5 at the pump. $6 becomes a floor, not a peak. Trigger 3. If hedge funds keep cutting oil exposure into a war, eventually they have to reverse. The smart money is short. The strategist note is calm. The reserve is empty. When the consensus has to flip, the price move is not gradual. It is a violent reset upward. The same kind of reset that hit 1973, 1979, 2008. None of those triggers are on the desk this week. All 3 are in the data. 68 days, 30%, $6 at the pump. $125 a barrel. 350 million barrels in a reserve that used to hold double that. 12% of hedge fund oil exposure cut in a single week. 2.4% break-evens on the 10-year Treasury that have not moved a single basis point since the war began. These are not random numbers. These are the numbers Wall Street refuses to price. The next strategist note will say it again. Tail risk contained. 6 different price levels. Same sentence. The reserve is empty. The smart money is selling. The break-evens are flat. The VIX is calm. The gauge they should be watching is screaming. The market is pricing the war ending. The data is pricing the war breaking everything. One of those is wrong. And when the consensus has to flip, it does not flip gently. It snaps. We have seen this before. 1973, 1979, 2008. The pattern is not a mystery. The pattern is in the data. The pattern is on every desk in Manhattan. They just choose not to see it. We see it. That is what mispriced is. Subscribe. We call the mispricing before the market does.